Hi, Ken Boy with the Accounting Accidentally site. This video is called Hurricane Milton, Extraordinary Losses and Profitability. So I'm recording this the day after Hurricane Milton barrels across Florida, leaving millions without power. We all saw on social media, I'm sure, and news reports, every wind, rain, and tornadoes. Huge destructive path, millions without power. And I bring this up because this has a big impact on business. Thousands of businesses in Florida will likely have large losses from this storm, and how those losses get reported has an impact on investors, and you need to understand how these appear in the income statement. So we're going to go over two types of losses and categories that you're going to see on the income statement. The first being extraordinary items, gains and losses from events that were unusual and infrequent in nature. That word "and" is important. They're non-recurring one-time events. It's outside the company's ordinary business operations, but I'm going to touch on that at the end. For example, damages from natural disasters like a storm, or gains from the early retirement of debt. Non-recurring, unusual, and infrequent, they get reported separately on the income statement. You'll see that in a few minutes. Extraordinary items are different from another topic, non-recurring items. This is from Investopedia, by the way, refers to an entity that appears on the financial statements, unlikely to happen again, and is considered infrequent or unusual. Instead of "and," it's infrequent or unusual, which is why I have it highlighted. For example, litigation charges, restructuring charges, you're reorganizing a business unit, merger acquisition work, gains and losses from the sale of assets, write-offs or write-downs related to business operations, assets aren't as valuable as they once were, you have to write them down, or losses related to shutting down a business unit. So these are non-recurring, which are different from extraordinary items. Now let's talk about where these get reported. So what I did was go out and do a screenshot of Apple's income statement. This has to be over a period of years. And so the point I want to make is you've got EBIT, earnings before interest and taxes here. And then below it, you have the unusual, may not be recurring items that are not part of normal operations. So unusual expense, they've got one over here. Non-operating income, maybe they sold something for a gain. Interest expense. And when you have get through all these unusual items, EBIT, less these unusual items, you get to pre-tax income. So the emphasis here is two things. Number one, all these items are reported below operations, normal operations profit. And it's important to understand that a profitable, healthy company cannot survive unless it generates profit from EBIT from normal operations. You cannot rely on these unusual items to generate a profit consistently from one year to the next. So the key takeaways here are that if you have losses, they may be extraordinary or non-recurring, and to understand the differences between the two, and that healthy, profitable businesses need to generate income from continuing day-to-day operations every year to remain profitable over the long term.